I don't want to bring bad news, but there are concerning signs ahead. I'm talking about the alarming drop in housing prices. If you're not cautious, you might get caught up in the 2023 housing market crash. I know it might sound like another scare tactic, but I'm not here to scare you. The truth is, the housing market can be unpredictable, and there are clear warning signs we can't ignore. Let's break down the important points. Housing prices dropping. The decline in housing prices might initially appear as a welcome development for potential homebuyers, offering the prospect of affordability in what has often been considered a prohibitively expensive market. However, this apparent silver lining conceals a more ominous cloud on the horizon. The reduction in housing prices is, in fact, a telltale symptom of a broader and more profound problem that the housing market is grappling with: overinflation. The term overinflation refers to a situation where the prices of real estate have been artificially inflated beyond their intrinsic value. Such conditions are typically unsustainable and often culminate in a market correction or worse, a crash. The current scenario is reminiscent of the build-up to past housing market crashes, where prices reached unsustainable peaks. In these situations, prospective buyers, excited by the seemingly favorable market conditions, are lured into the market. They might believe it's an opportune moment to invest in their dream homes, or even consider real estate as an attractive investment option. However, just beneath the surface lies an unsettling reality. Housing prices are not determined solely by the dynamics of supply and demand, but are also significantly influenced by market speculation and factors unrelated to the intrinsic value of the properties. This speculative behavior can lead to rapid and unsustainable price increases. As housing prices soar, a dangerous bubble forms, much like a balloon that's been inflated to its limit. When this bubble eventually bursts, it can trigger a cascade of repercussions throughout the housing market. Homeowners who entered the market at the peak of the bubble risk being left with properties whose values plummet rapidly, potentially resulting in negative equity. In the broader market, this can lead to a downward spiral of decreasing property values, reduced demand, and a surplus of homes for sale. The consequences of such a housing market crash can be severe: economic instability, financial distress for homeowners, and a ripple effect that touches various sectors of the economy are all possible outcomes. Therefore, it is crucial to understand that the current drop in housing prices, while appealing at first glance, is not a standalone benefit but a signal of instability in the market. To navigate these uncertain waters successfully, it is vital for prospective homebuyers, real estate investors, and homeowners to exercise caution and prudence. An in-depth understanding of the factors driving the market is essential, as is a long-term perspective that prioritizes sound financial decision-making over speculative gains. As history has demonstrated, housing markets tend to be cyclical, and the ability to weather downturns is as important as the ability to capitalize on upswings. Declining demand. The alarmingly low mortgage loan applications reported by the Mortgage Bankers of America are sending shockwaves through the housing market, highlighting a substantial decline in the demand for real estate. The gravity of this situation becomes even clearer when we examine the primary driver behind this sudden drop in demand: the sharp and swift increase in interest rates. Interest rates, a key determinant in the affordability of homeownership, have risen precipitously in recent times. This dramatic escalation has created a sense of unease among potential homebuyers and has deterred them from entering the market. The fear of higher borrowing costs has instilled a sense of apprehension as individuals contemplate the consequences of taking on larger mortgage payments. The surge in interest rates has had a chilling effect on the housing market, particularly for those who had been poised to enter it. The prospect of paying significantly more in interest over the life of a mortgage has caused many to reassess their financial plans and reconsider their timing for making one of the most significant investments of their lives. This phenomenon of interest rates impacting the demand for housing is not confined to prospective homebuyers. It also has implications for homeowners who might have been considering refinancing their existing mortgages. The higher rates mean that the potential savings from refinancing are significantly diminished, which can have a further dampening effect on the overall demand in the housing market. What's more, the increased interest rates may not only deter new buyers and refinancers, but could also put pressure on existing homeowners. As they renew their mortgages, they will face higher monthly payments, which can strain their financial capacity, leading some to consider downsizing or selling their homes. This in turn can contribute to an increased supply of homes in the market. The sudden and sharp hike in interest rates is one of the most salient indicators of the housing market's vulnerability. It underscores how sensitive this market is to changes in economic conditions, monetary policy, and broader financial market dynamics. It's important to recognize that the relationship between interest rates and housing demand is not linear. The market's response to rising interest rates depends on a host of other factors, including the state of the economy, the availability of housing inventory, and consumer confidence. Furthermore, the psychology of potential homebuyers plays a significant role. If they believe that interest rates will continue to rise, it can lead to a sense of urgency to secure a mortgage at the current rate. In conclusion, the decline in housing demand, triggered by the surge in interest rates, is a pivotal issue that could potentially have profound implications for the housing market's health. As prospective buyers and current homeowners grapple with the implications of these rising rates, it underscores the interplay between economic factors, human psychology, and market dynamics that shape the real estate landscape. The consequences of these trends will continue to evolve as the housing market navigates through this challenging terrain. Imbalanced supply and demand. The disparity between housing supply and demand paints a complex and concerning picture for the housing market. This imbalance threatens to send ripples through the industry, raising red flags and concerns among industry experts and prospective homeowners. Demand lags behind supply. The most immediate issue facing the housing market is the stark divergence between supply and demand. There's an excess of available homes compared to the number of buyers looking to make a purchase. This oversupply scenario is usually seen as a boon, potentially leading to more affordable housing. However, the nuances of the current situation suggest otherwise. Contributing factors. Several factors have converged to create this precarious situation. Economic uncertainty, brought on by volatile financial markets and an unpredictable employment landscape, has sowed doubt among potential buyers. They are increasingly reluctant to make substantial financial commitments, such as purchasing a home during such uncertain times. This reluctance adds to the lag in demand. Urban property versus limited supply. A peculiar and challenging dynamic is at play. Urban properties are experiencing a surge in demand. People are drawn to city living for its conveniences, job opportunities, and lifestyle. However, the supply of urban housing remains limited, contributing to the demand-supply imbalance. In contrast, suburban and rural areas are facing a different set of challenges, with an abundance of available properties but a lack of interested buyers. Months of supply. The months of supply metric, a crucial indicator in the housing market's health assessment, is rapidly decreasing. At the present low of 3.1 months, this statistic signifies a potential shortage of homes. While this may sound counterintuitive given the surplus of housing in some areas, it speaks to the intricacies of the market. This dwindling supply amplifies the challenge for prospective homebuyers. It is the driving force behind increasing competition for the limited available homes. Simultaneously, the heightened interest from investors and corporations compounds the problem by applying upward pressure on prices. As a result, individual buyers may find themselves grappling with even more formidable affordability barriers. Low liquidity. Low liquidity remains a persistent challenge within the housing market. It influences the swiftness and ease with which transactions occur, particularly when market conditions are in flux. Even in more stable times, the process of buying and selling homes can be cumbersome, marked by delays and intricacies. Yet, during periods of market volatility, these challenges become exacerbated. Low liquidity can pose significant problems for sellers. Swiftly adapting to changing market conditions by adjusting their prices to match the current market state becomes an onerous task. This can lead to overinflated prices that are, in the long run, unsustainable. Speculation and fear. The current state of the market can be characterized as a phase of speculation and fear. Investors and speculators are driven by the fear of missing out on potential profits, which can skew price dynamics and create a precarious bubble that is ultimately unsustainable. Speculative behavior can add an additional layer of complexity to an already delicate situation. It distorts prices and creates uncertainty about what constitutes a sound investment. This irrational behavior further destabilizes the market, making it challenging to predict how it will evolve. Preparing for the worst. In these times of uncertainty, remaining composed and avoiding impulsive decisions driven by fear and trepidation is essential. It's in moments of extreme fear or exuberance that individuals often make choices they later regret. A long-term perspective and realistic decision-making should guide anyone involved in the housing market. Additionally, it's prudent to prepare for potential job losses and their impact on the housing market. As economic conditions remain volatile, the prospect of job loss becomes more pronounced. This, in turn, can prompt individuals to sell their homes quickly, potentially exacerbating the market's instability. In conclusion, the housing market faces a host of challenges, including supply-demand imbalances, low liquidity, speculative behavior, and a lack of long-term thinking. Staying informed, exercising caution, and preparing for potential market fluctuations are key to navigating these turbulent waters successfully. The interconnected nature of these factors underscores the complexity of the housing market and the importance of a well-informed, strategic approach.